Now, our next guest says any anticipation of a quick recovery based on so-called green shoots is built on hope rather than reality. He expects an extended period of below-trend growth. We're joined by Jim Keegan, co-manager of the RidgeWorth Intermediate Bond Fund. He helps manage $20 billion for the firm, and he's also the chief investment officer at Psych Investment Advisors. And your fund, I know, has had a great long-term performance, beating, I think, all your peers over the last 5 years. So good afternoon.
Thanks. Good to be here, Carol.
So talk to me about this idea of green shoots. This caught our attention. I know there was an interview done in Barron's back in mid-May, and you said you don't buy into the green shoots and Glimmer camp when you've got more than 500,000 people losing their jobs. You know, last Friday, it wasn't 500,000, it was 345,000. You still don't buy the green shoots argument.
Well, I mean, 220,000 came from the birth-death estimation model. So
be careful about those numbers.
Be careful about the numbers. Yeah, absolutely.
Why, though, Jim, in general, don't you buy this green shoots argument?
Well, I think the consumer is retrenching. I think there's a secular change going on in consumer spending behavior where the consumer has figured out that they can't borrow their way to a better life, and they want to pay down debt and repair their balance sheet. And then when you add on top of that the demographic wave of 77 million baby boomers retiring with inadequate savings, it says that savings has to go up, and by definition, spending will go down.
So even if they don't want to save, they really have to.
They have to save.
So it's going to be a significant shift, and it's going to stick.
We think that consumption is going to fall to its long-term average of around 65% of GDP from where it is right now, which is a little over 70%.
So, Jim, even though there are some data points that show some signs of stabilization, you know what they are, whether it's consumer confidence, some housing data points, doesn't matter because of the shift that we're going to see among consumers.
Absolutely. And if you look at, like, the consumer confidence data, that's soft data because most of the increase in consumer confidence is coming from the expectations part of the survey, not from current conditions. So it's almost like people are in the hope trade that things are going to get better.
Right, and that's not reality, is it?
No.
All right, so talk to me about strategy. I mentioned you've got a great track record. You know, over the past 5 years, you've really beaten all your peers. So what kind of strategy do you take in this environment?
In this environment, we've been of the view that investment-grade corporate bonds represent the best value in the fixed income markets. We have been overweight investment-grade corporate bonds, but the overweight within the investment-grade corporate bonds is very defensive. We're focused on what consumers need rather than what consumers want. So very defensive, consumer staple-type credits, food, beverage, pharmaceutical, healthcare.
No high yield.
We do have a little high yield. Yes, we absolutely have a little high yield.
Okay, but that's not your focus, you said. You're really going for quality here.
Quality. And even within high yield, we're going for quality.
Interesting. All right.
Balance sheet strength is extremely important.
All right.
This is a balance sheet recession.
All right, 30 seconds left. I mean, you had some great foresight about kind of what happened and what's played out over the llast year and a half. What's the next maybe shoe to drop? Is it commercial mortgages and what that does to the overall economy?
It's already here.
It's already here.
It's already here. The commercial mortgage shoe has already dropped.
How bad is it going to be? We just got a few seconds.
I think it's going to be pretty bad. The CMBS market's about a $700 billion market. Look at some of the recent transactions that have taken place, whether it's the Hancock Tower up in Boston that sold for about effectively 40 cents on the dollar.
Right. So much more severe than what we've seen in the residential mortgage market.
Absolutely.
Many times as well, right, in terms of the size.
Could be.
All right. Good to know. Jim, we'll have to get you back here. I'd love to talk some more.
Thanks, Carol. Appreciate it.
Jim Keegan, everybody of RidgeWorth.